Hi everyone, welcome back to Be Rich. It's me Vinod here, sitting in Bangalore still, recording remotely, sitting in an office. Which office? I can't say, but you can guess, I guess. Anyway, what did I want to talk about today? Well, if you did notice, the market has been here and there as expected. IndusInd Bank corrected slightly today because a lot of people are seeing opportunity in IndusInd Bank, so they must be looking at it. But what is stark, which most of you must have realized, is all the IT stocks which we've been talking about for such a long time are all taking a severe beating. Infosys, Wipro, TCS, a lot of the IT stocks which you're looking at and have been talking about for some time are taking a severe beating. A lot of you are wondering why, what happened. Just a few months back, Anand and you were talking about IT stocks very differently. We were talking about ETFs. Then suddenly, a few weeks back, I even told with Dana, don't look at ETFs, IT ETFs that too. And I then spoke about it in a video where I spoke about ETFs and mutual funds, what's the difference and comparison between them. And I said, please avoid IT ETFs for the time being because there's a lot of pain, there's a lot of uncertainty in it, and that is going to take some time to get clarity. As you've seen, Trump with his tariff plans, even he doesn't know what he wants to do with tariffs. One day it's on, one day it's off. He signed so many tariffs, he doesn't know which tariffs have to kick in now. People are very confused. Is it 25%? Is it 50%? Or is this the one which is being put on hold? You can imagine if you were the officials sitting at the border there in the US, trying to go through customs, trying to figure out if it is being paid or not being paid. Or if you're a business owner, should you be invoicing it like this? Should you be invoicing it like that? This nightmare is what is creating the quakes in the market. More than the tariffs, it is a problem that he himself clearly doesn't know what he wants to do. If there was a clear direction in leadership, then there will be no problem. Markets will factor that into their earnings. Businesses will factor that into their invoicing and costing. Customers will know, okay, this is what's going to be the tariffs, there's the new charges. Then there will be a system which will be in place to understand this, and we'll move forward with the new costs. Then inflation kicks in. But here, what is happening currently with Trump is he is, depending on his mood and his frustrations, he takes it out on all of us. And this is the strangest thing I've ever seen in my life as far as leadership is concerned, and that too, this kind of leadership coming from the US. So that said, we spoke about stocks, we spoke about what's happening in IT. Yesterday in our group, I was talking about how to protect your retirement fund. If you're young, like a lot of you are, most of my viewers are very young. You're in your 30s and 20s, especially the NAS viewers are very young. So this is something you don't worry about. This is more people who are my age or older to me, closer to my brother's age, who are planning to retire in the next few years. Or those of you who are closer to my brother's age, who are going to be retiring probably in the next few years. So this is directly to them which I'm talking about. Of course, this applies to all of us because these conditions may happen to me or may happen to you when your time comes to retire. Because all of us invest in the hopes that we are rid of the cycle of trying to earn money to make a living, that we invest enough, that we may live off our investments and be free to do things we always dreamed of doing, whatever they may be. So what is this? How do you protect it? If you've come, let's say you've done all the good things till now, you forego all your immediate gratifications and you've been investing and you've been doing it for the last 10 years, 15 years, and now you're about to retire and you want to reap the benefits of this, but suddenly the market is down 30%, the market is down 20%. What do you do? That is what I wanted to talk about. First, when you retire or when you're about to retire, you have to do something known as balance your asset allocation. Your assets so far have been invested in such a way towards your retirement, whenever that was supposed to be. But now that you are going to retire, you have to relook this and revisit it to see how your assets have been allocated thus so far and see how to reallocate it, to rebalance it. My advice would be, if you think about it, you should try and keep at least 40 to 60% of your retirement, whatever your funds you've created, the corpus, the principal, in large cap and Nifty index fund. That means in equity. So 40 to 60% should be in equity. If you're older, maybe 40%. If you're younger and you're retiring, maybe 60%. So that depends. The reason why I'm saying 40 to 60, and it's a huge difference, 40 to 60, is depends on what age you are at the time of retiring. That means shows you how much more runway you have. The next thing which you do, once you've allocated 40 to 60%, that's in large caps and Nifty funds, is to look at debt, which is bonds. So 40 to 50% can be in bonds. Again, here I'm giving you a wide range, 40 to 50% of your principal should be in bonds. And the reasons why it should be bonds is this is secure, your capital is protected, and you get assured returns on interest, whatever. It's like an FD. So 40 to 60% should be in bonds. The last portion which is left, around 15 to 20%, that should be in gold. Gold is the security which you can hold on to in these kind of volatile markets. Many of you who have been following Anand, especially for the last 2-3 years, and been investing with this strategy, will know that your returns in gold outshine any of your other returns in equity over the last 2 years because gold has performed so well, especially when markets start getting troubled. So this is the way you should balance your portfolio. Then what should the next thing you should keep in mind if you're planning to retire now or anytime soon? The next thing is maintaining a cash reserve for emergencies. We always used to say to you guys that you should have 6 months worth of reserves. But if you're planning to retire, right, you're not going to be looking out for a job anymore. You're planning to retire and live off whatever you're invested. So there your cash reserves change. You don't need it for 6 months, but you need it for a year. So for a year or two worth of expenses, you should have as cash. And this cash can be put in short-term bonds, or better still, you can keep it in gold. If you cannot do both, then the worst case, you keep it as an FD, which I don't recommend because you don't hedge against inflation in an FD, but it's very liquid. It's easy to liquidate and pull the cash out if it's required. So at least 1 to 2 years worth of expenses should be very liquid in terms of keeping it as cash, either in gold or in short-term bonds. 3. This is very important. You need to adopt something known as a smart withdrawal strategy. The smart withdrawal strategy is understanding how the markets work, where your investments are, and how much you can actually withdraw from the market without eroding into your principal. Because you've saved all this, you've invested all this, you have your corpus now. So you need to know how to withdraw from it without eroding in it. As it's growing, how to remove the fruits from the tree without harming the tree, as they say. So in Indian scenario, in Indian markets, a safe withdrawal around 3 to 3.5% per year from your investments is a very safe withdrawal to do. That means if you withdraw that around that space, your investment, your principal amount, your corpus doesn't get eroded. It manages to keep growing. At the same time, it is able to give you something on a yearly basis. So if you're young and you're thinking about retiring 40 years from now, 30 years from now, this is the way you should look at your investment. 1, you first get to the number which you need every month when you're planning to retire. Once you know that number, find out how much you need per year, and that should constitute around 3 to 3.5% of your corpus. So back calculate and you'll know what is your corpus amount that should be, and now you know your runway, you know where you need to go, and you can back calculate this. I did a video about this specifically for youngsters with Dana. If you're interested, you should definitely see that video. So in India, you can withdraw around 3 to 3.5%. So what you need to know is how much will you need to withdraw depends on how much you have other income. Some of you would have invested and have some equity, already have some debt and some gold, but may be fortunate enough that you have some property. So you're getting some rental income already on a monthly basis. Or you might be having EPF or NPS. So you have other income coming in. So based on that, you should see how much little you can. Just because you can withdraw 3 to 3.5%, you don't need to. Because I'll explain that in a minute why I'm saying this. If you have other sources of income, factor that in and make sure you only withdraw what you need. Because the plan is, in bad markets, you try and reduce your withdrawal. In good markets, you have to withdraw more. So keep that in mind. When we are running a bull run, when you're going through a bull market, you should think of withdrawing more than you need because your corpus is growing. The reason why you do that is, when you reach a bear market like what we're entering now, you can withdraw less. So that way it is flexible. Of course, the problem here lies, it is purely on your judgment. What you think a bear market is, what you think of what a good market is, because human mind is such that when markets are good, you're seeing an investment grow, you hesitate to withdraw at that point of time. Then when you see the bear market, when you should not be withdrawing, you see your investments going down, you get nervous and you feel like withdrawing more. So actually what you should do is in reverse. So keep this in mind. So another thing you should keep in mind when you're doing all this withdrawal is the investment which you have put, is it able to support the withdrawals you're planning for? Because all of us do our investments and we have reached this stage now that we are invested. But unfortunately or fortunately, some of you may have done enough investment, some of you may have not. So it's always important to first calculate and see if your withdrawals is able to be supported by your corpus fund which is in the market. So always keep an eye on that. So protection against inflation is important. That means to keep in India, inflation is around 6 to 7% to be conservative. Me and Anand always think it's a little bit more than what is stated at. So it depends on your point of view, but at least keep it 6 to 7%. That means keep a larger portion in equity because stocks give better returns in the long term, even when you're retired. And look at gold ETFs, and even dividend paying stocks is another great option at that point of stage in your life once you've retired. The next thing you should keep in mind as you're reaching retirement is planning for healthcare expenses, because your corpus is supposed to support that also. Make sure that you have a good health insurance. If you have not taken, make sure you take one before you retire. And the health industry in India is such that it's run completely by private industries. The government really doesn't play in healthcare and health insurance. So you have to learn to support yourself. So keep a separate medical fund also. Aside from your 1-2 year fund, which I told you, keeping it liquid, do keep a separate medical emergency fund. In case of an emergency, you can dip into it. In case your insurance is taking some time or some prerequisites not being met, you still have funds enough to take care of yourself. In terms of health insurance, at least make sure you have 10 to 25 lakhs coverage if you're a couple. If you're larger than that, make sure you take a larger coverage. So what does this mean to all this? Well, this is the plan which you should keep in mind. All these things which I said, all these points, you should keep it in mind if you're planning your retirement. And the last thing which I want to say is, some of you may not need to withdraw this money, as I'm saying, because you're fortunate enough to be in a position where you don't need to withdraw it. Then of course you can leave it and keep your withdrawal minimal, so you can leave it as a legacy for your children and your family. For those of you who are in another situation where your family is doing very well, your children are doing very well, and they don't have any need for your wealth to be passed on to them, do consider withdrawing a larger amount and enjoying the last few years of your life in a way that you deserve to. Because all of us work towards this point in life to enjoy the last 10, 15, 20 odd years of retirement. And if you're fortunate enough that your children don't need, or you don't have any children, you don't have any dependents who need your legacy to be left for them, do think about withdrawing a little more and enjoying it when you're able to enjoy it. This is my last piece of advice for all of you who are retiring now, or retiring early, or retiring soon. How you should plan, especially in these kind of markets when the markets have turned bad, and how should you think about it? How should you withdraw? Is what I wanted to share with you today. I hope you found this video informative and entertaining as always. Do like, subscribe and share. Do put down in the comments what you feel and think. And I'm always there on Instagram. You can reach out to me there. Like yesterday, I had a long live conversation where I did a Q&A with a lot of you guys. So do join me in that group over there. We do have a lot of fun trying to learn together and analyze together. Today morning, for instance, we spoke about Airtel and should we look at Airtel because of Starlink. I shared my opinion about the debt in Airtel and how the debt in Airtel is what the problem is. And if you're really keen on going to new age technology and new age companies, looking at something like a Google is a far better bet than trying to look at something like an Airtel here in India. Anyway, thanks for watching the video. Like I said, have a wonderful evening, and I'll see you again tomorrow from Bangalore as I sign this week off. Thank you for watching Be Rich Today. Bye.